How can you make $1,000 a month from index funds, cryptocurrency, or individual stocks? More importantly, how hard is it to get started with these options? And if you only have $1,000 to invest, which one is going to be the best for you? It's important to know this information because with a bank, at best, you might be getting a 1% interest rate, and the average return from an index fund is 10 times that amount. I've put my money into all three of these options, so I'll be giving you my opinion on the unique pros and cons to help you make a decision on which one is going to be the best option for you. Firstly, jumping into ETFs or exchange traded funds. This is essentially just a collection of companies all put together based on an investment goal. So you can get ones that will track specifically dividend yielding companies, sectors in the market like technology or healthcare, and then you can also have ones that might look at a specific commodity like gold or silver. They normally offer quite low fees, and they're a really easy way to get exposure to lots of different companies. Instead of having to buy one share of Apple or one share of Tesla, you can just get an ETF that has all these different companies within it. The most notable one is the S&P 500, and that's just going to track the biggest 500 companies in the American market. So your money will be spread across 500 different businesses, and these include Coca-Cola, Facebook, Microsoft, Amazon, all very big players. So buying an ETF is an easy way to essentially buy a piece of the whole stock market. What I've learned from ETFs is that normally you don't make money very quickly. They typically have a nice consistent increase, and you normally get a return either from the share price going up or having a dividend paid out to you. Now, there's definitely some really good options with ETFs, but one of my personal favorites is SCHD, or the Schwab US Dividend ETF. It's just a collection of very profitable dividend companies that always have a consistent payout. So with this, the average return across 10 years is going to be 12.5%, and the dividend yield is 3.2%. So it has a really good compounding effect the longer you hold your investment. So if you're taking a look at a one-time investment of $1,000 across 10 years, you're going to have $4,500 at the end of it. If you invest for a little bit longer, say for 20 years, then you're going to have $18,600. If you start contributing some of your own money, you're going to get some very nice returns. If you wanted to start making $1,000 per month, then keeping in mind that example of $1,000 invested initially and then putting in $100 per week, if you do that for 18 years, by the end of it, you're going to have a portfolio valued at $437,000. So the dividend payout of 3.2% is going to be just over $14,000. And then that means if we divide that by 12, so 12 months in a year, every single month you're going to be getting $1,167 from this investment. So it does take quite a while to get there, but it can be done, and it's roughly the time horizon you'll be looking at. Another excellent investment that you can make is dropping a like and subscribing to the channel. So starting and maintaining this strategy is very straightforward. To start investing, all you need to do is set up a brokerage account so you can start buying shares of a company. I personally use Stake and Hatch as my brokers, and signing up is very straightforward, and it's virtually the same regardless of which platform you're using. You'll just have to give your email address, your phone number, date of birth, your personal info in terms of some ID like your driver's license or passport, just to verify your identity, and it just takes a few days for this information to get processed. Most brokerage accounts don't even have a minimum investment amount, so you could just start with say $10 and build up your portfolio. And to continue the growth of your investments with ETFs, it just comes down to, can you keep contributing a consistent amount of money? And even if you don't, you're still going to have a very good compounding effect, even if you don't put any extra money in. And the biggest thing is just making sure that you pick out a nice stable ETF. Some other great options besides SCHD are VUG or VOO, and then there's also a nice growth ETF called QQQ, which has had an average return of 16% over the past 10 years. And you got got to look at it with a nice long time horizon, say 10, 20, 30, 40 years, looking at it as a long-term high interest savings account, and you're not going to be chopping and changing, selling between different ETFs all the time. You're more or less going to pick one or two and just hold those for as long as you can. Moving on to individual stocks. In my experience, these can be a great way to make a lot of money in a short space of time, but you have to stay very involved in the process and always do consistent research in whatever companies you're investing in. You're basically betting your money on one individual company, so you're at the mercy of the stock market and the effect that it can have on one business on its own. You don't have the security that comes with ETFs. The price of a stock can go up and down for lots of different reasons, like public opinion, any news reports that come out about the business, inflation rates, and this list goes on and on, but there is always a need to stay updated on a company. Just because one year does really well and has a great return doesn't mean that's going to be replicated the next year. Public opinion is a massive driving factor in the short term. Taking a look at companies like GameStop, which had gone up over 1,000% in just a few weeks, purely because of the perception and how much hype it had in the media. But it does eventually come crashing down, and that hype isn't always sustained. So with individual stocks, you can basically pick out two main options, either growth-based companies like Tesla, or nice established businesses or blue chip companies like Apple that have a more consistent return. I'll give you an example for both of these to help you make an informed opinion on which one is the best for you. Taking a look at Tesla for the first option, if you had invested into this 1 year ago, you would have been down 32%. But if you had invested at the beginning of the year on January 3rd, then you would be up 82% at the moment. So the timing really makes a big difference. In my personal opinion, investing in companies like Tesla can be quite a roller coaster. I personally had invested all of my life savings into that business, and at one point I was down almost $8,000, but other times when the stock was doing well, I could be getting a few $100s every single week just from the price of it increasing. So it is a risk versus reward, and it can work out well, but it can also backfire very heavily. So I wouldn't advocate putting in virtually all of your money into one business like this unless you are very confident in it and you're consistently doing all of your research. So if you had perfectly timed your buying of Tesla in March 2020 and sold at the very top in November of 2021, you would have been up over 1,300%. So a $1,000 investment would have been worth over $13,000, and that means you would have been making $1,660 every month. Now, of course, doing this is virtually near impossible. You're never going to find the exact bottom and the exact top to buy and sell, but it just goes to show how big the difference can be of when you buy an investment with something like this, where the price changes can be so volatile. Taking a look at Apple, which has a much more consistent increase in its share price if you compare its stock graph to Tesla's, over the past 10 years, it's had an average return of 27%, and it's got a dividend yield of 0.63%. So if you had invested $1,000 at the beginning of the year, not including the dividend, then you would have made $270. And lastly, jumping into cryptocurrency. This is by far the most volatile investment that you can make, so you can get huge returns but also huge losses. When it comes to crypto, there's lots of different options available. So there's Solana, Dogecoin, Bitcoin, and Ethereum. Now the last two, Ethereum and Bitcoin, are essentially like the Apple and Google of the cryptocurrency world. They've remained amongst the longest standing and consistent cryptocurrencies that are available. Now if you're going to start investing in crypto, I'd recommend that you'd start with these two, since they have the most proven track record and the highest market cap as well. It can be a good idea with crypto to not hold the investment forever, since it's quite normal for the price of the whole crypto market to fall by over 80% during a bear run. So you can lose a lot of money in a short space of time, and taking profits along the way is a pretty advisable thing. I've learned this firsthand when some of my investments fell almost 80% during the last bear market that we had. So it's not about always buying and holding forever in the crypto space. Taking profits and converting them into a stable coin like USDC is a very good option, because stable coins virtually hold their value and don't have these massive price jumps the same way that you might experience if you're having your money in something like Bitcoin. How much money you make from this really depends on when you invest. If you had invested $1,000 into Bitcoin at the start of the year, then you would currently be down 32%. However, if you timed your investment perfectly, like with the Tesla example, if you had bought in March of 2020 and sold in March of 2021, then you would have made over $10,000 from your $1,000 invested, so just over $800 per month. But perfectly timing this and getting a 1000% return is almost near impossible, but it does show you the potential that the crypto market has. And since the peak of its last big run, it's come down just over 40%. So there's a lot of variability with how much money you make based on when you buy the investment. This still leaves some important questions to answer, like what is a very consistent way to make money routinely every month without having the chance of losing so much of your investment. Now, one of the best options is putting your money into dividend yielding stocks. So which ones are going to be the best for you? How much should you invest, and how long will it take to always make a consistent payment of $1,000 each month? Make sure to click this video on screen to see the best dividend yielding strategy to always make consistent returns.